Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Steve Wyett, Chief Investment Strategist at BOK Financial, as well as Steve Sosnick, Chief Strategist at Interactive Brokers. We're here to discuss why it's all about the bond market, since a sell-off in stocks neither threatens a broader financial system nor economic output. It is great to see the both of you guys, as always. Steve Sosnick,
rabbit hole, but then there was the fear that the so-called basis trade was imploding, and that's a trade. It's an index arbitrage trade, basically. For a stock people point of view, but from the bond point of view, it's trying to find little discrepancies between the cash bonds and the futures, the bond futures and the cash bonds that underlie them. But the problem with those trades is because they're generally risk-free, because they don't differ by too much, those rates, they can put those trades on at 20 times leverage, I've heard, is the average, and 50 long-term those are long-term capital type of amounts of leverage. Right. And so if you start to get primary dealers getting into stress with bond markets, that's problematic. It turns out that really wasn't the case so much. I think it was largely positioning ahead of the 10-year auction on Wednesday and the 30-year auction on Friday. There was some fears because the yuan reached some record lows. There were some fears that the Chinese were going to be stepping back from the auctions. But since then, we really haven't seen rates. We're seeing rates improve now as we're talking about 10 to 14 basis points across the curve. But we didn't really see rates improve. And more importantly to me, we saw the dollar get absolutely hammered. DXY went from about 103 to about 99, and that's not bouncing back today, whereas bonds are. And so that was the way I interpret that is foreigners were voting on the U.S. And, they don't get to vote in our elections, but they do get to vote in our markets. Yep. And I think they were voting no.
Yeah. Well, I mean, Steve Wyett, the question is, no one has a crystal ball. Are we at peak uncertainty? Because a lot of this was self-inflicted wounds. I mean, the economy, the market fundamentals were quite good. Now you're into you're starting to get into the earnings seasons, and you're expecting corporate management teams to give forward guidance in an operating environment that's quite unclear.
Yeah, so I think, look, we could all agree that the implementation of tariff policy has at best been inelegant, right? At times it's way worse than that. And you're right, all that does is create a lot of uncertainty. That takes the ultimate goal of what we're trying to accomplish to reshore jobs and have a more resilient economy. It puts that at risk because those are the types of actions that we need from corporations that aren't going to happen in the next 30 days or 6 months. I would offer this, Jill. We're in a better position now, I would say, from a tariff standpoint, where we paused all of these reciprocal tariffs. It seemed like the market was set up for this idea of, hey, 10% tariffs, send a message to our trading partners and focus on China. And I think if we had started there, we would have seen a lot less volatility. And the fact of the matter is, China is not just a problem for us. They're a global problem. And so we probably would have had some that showed the reciprocal tariffs. And you see a country like Vietnam get whacked with a 46% tariff. It's just not a good look for the big guys to pick on the little guys like that. And the reality of it is, I think, Jill, I'm not sure we want every manufacturing job back in the United States. Selling T-shirts is not a high value proposition. Making tennis shoes is not a high value proposition. Now, are we at risk that we have parts that we get from China to make our F-35 jets? Of course we are. So there are areas where we need to be paying attention to what we're doing. But the way we've approached this so far, it just seems like there's been a whole lot of collateral damage that could have been avoided if maybe we would have taken a little bit more thoughtful approach.
Yeah, because at the end of the day, we were in the process prior to the new administration where we were diversifying supply chains based on lessons that we learned from COVID, right? Where we were looking at other areas to get, so we weren't so dependent on one region or the other, but through the expectation for all manufacturing jobs to come back to the US, which I don't think people are rushing to do those types of jobs. Why not be more forward thinking and upskill and reskill for the jobs that are going to be necessary over the next 5, 10, 20 years so that we remain the leaders when it comes to innovation, whether you're talking about capital markets or technology innovation and so forth.
I'm voting for you when you run for office, Jill.
Yeah.
You've got my vote when you
But
run for office.
it's the execution, and what does the end game look like? I mean, if you use Singapore as an example, and the model, from when they became independent and they had nothing, no manufacturing, no economy, but forward thinking, and how do we set ourselves up to be global leaders in, the next century, as an example. So we were doing the diversification thing. We were trying to make sure that our, supply chain was more secure. Steve Sosnick, we were on that route.
Yeah. Well, yeah, that's to Steve's point. I think had the tariffs been more targeted, very strategic, saying, we need to have this industry beefed up because we run the risk. Whether some of the examples have been pharmaceuticals and defense oriented stuff,
Right.
So some agriculture type of things. I get it, and I think that for example, there was actually bipartisan agreement on very targeted tariffs against China because Trump one put them in and Biden kept them in. So
Right.
there was a commercial logic to some of that. And I think, had there been some international cooperation and a bit more thought about targeting these tariffs, they wouldn't have been the bombshell that they became. But for example, you talked about picking on the little guy. Madagascar had one of the biggest tariffs because it was really net imports divided by total imports,
Right.
was the figure, give or take. Madagascar produces basically they import nothing because they're too poor, unfortunately for them. But
Yep.
they don't produce much, but the one thing they do produce is vanilla. And so it's not like we had a domestic vanilla industry to protect. So there's no point in tariffing that stuff. All it does is make things more expensive that people want here. That's a problem. If you told me that, okay, so you want to reshore semiconductors, well, that's kind of what the CHIPS Act was going to do, but you want to beef it
Right.
up a bit. I get it, and I think the public and our trading partners and our allies would be behind that. I think but I'm not going to pick on the penguins. That's not fair. But like a lot of the countries, let's say in Central and South America, where we import out of season fruit because in South America it's summer when we have winter and we still want to eat tomatoes and blueberries, or they grow mangoes and things like that, where we don't exactly have a domestic mango or enough of a coffee industry. That was lunacy, and the problem there is that then got unwound in the sloppiest possible way, and it looked like capitulation. I think we need a reset, and I hope we're going to get one because there are aspects of this that make sense, but there are a lot of aspects that don't, and the market is telling you this. And the fact that you saw this flight out of bonds and flight out of the dollar is particularly European investors, because it stopped exactly at 11 o'clock on Friday, which is when you're 11 o'clock Eastern time, which is when Europe goes home. That was my tell that was a lot of European investors just saying, you know what, we want to lighten up on the US. We export a lot. We export our capital. We export debt. We export debt and we export equity, and foreigners buy that from us in exchange for the trade deficit. So that in some ways is not helpful at all. Because
Steve, can I expand on that just a bit, Jill, because I do think this is an important thing for us to consider. As we've got $36 trillion in debt, we got to roll something like 9 trillion of that this year. One of the byproducts of us shrinking our trade deficit is we, by definition, are going to have less support from foreign investors, because a lot of these countries take these excess dollars, if you will, from their trade deficit, and they recycle that into the treasury, into treasury bonds. So there's going to be some impact to the demand on our treasury markets as we move forward on this, and I think that it's important to keep that in mind. This shift where bonds went up in yield and the dollar declined. Look, Steve's right. We don't want to mitigate the importance of that. It is a bit telling, though, if you step back a little bit and look at longer term charts on where the dollar is versus our trading partners. We're not at levels that would tell you that we are at significant stress. So it's never a good sign in the market when you see asset classes act completely different than they've acted in the past. But I think the risk that we might have as investors, to your point, Jill, earlier about peak uncertainty, we need to be a little careful about extrapolating that forward and saying, okay, this is what this means over a longer period of time. I think the news flow can begin to get better, Jill. We can start we can't keep talking about tariffs 24/7 for the rest of the rest of this year. We're going to see Congress get engaged. We better see Congress
They have
get
to. They have
engaged. Maybe I
midterms
better put
coming
it that way. We better see them get engaged, and they better start talking about tax policy, deregulation. This is all tied in with immigration. We've got to see Congress start to take some action to kind of shift the narrative away from all of the negativity on tariffs to maybe some more positive outcomes, which are there. And all of the promises of AI is still in front of us. But I would say this now, we have to win AI as a country. We have got to win AI.
Oh, you know what? It looks like you froze, but Steve,
Yeah.
oh, Steve White, we
No,
lost you
we
for a
have-
moment here. It looked like you froze, but Steve Sosnick, we can carry that conversation forward as well. The thing is, though, we need a lot of those, rare earth components, if you will, for batteries, as an example, for other technology needs to satisfy that demand. It's more than just tariffs and closing a deficit. This is, our trade partners need to trust us.
Yeah, and that I think has been eroded because they don't know what the landscape is economically because the target's been moving. We certainly have done nothing really to embrace the first round of tariff talk seemed to be almost the opposite of the advice from the Godfather, which is keep your friends close, keep your friends close, your enemies closer. This was almost like push away your friends and push away your enemies more. That's not really conducive to this, to moving forward. To Steve's point, I want to reiterate that because I did write a piece, literally just came out like a few minutes ago on our website, where I basically said, I pointed out how disruptive these moves were, but yet they're not at levels that shook anything. We didn't reach new highs in yields. We didn't reach new lows in the dollar, although we are flirting with a post-COVID low on the dollar, but we're not there yet. So your point is very well taken. This is disruptive. There's a lot of short-term volatility. And one of my mantras is when you have, let's say, the 2-year note moving 11 basis points a day, that kind of thing, is if the market's having trouble pricing relatively risk-free assets, it's not going to have an easy time pricing riskier assets. And that's something to keep in mind. Until you see the bond market, and I keep throwing it back at them, but if you keep seeing the bond market sort of gyrating around 10, 12 basis points on the short end of the curve, you're not going to get a lot. And one of the things that might keep it gyrating is, as Steve mentioned, in terms of Congress getting engaged, and you mentioned, Jill, the debt ceiling is coming back to haunt us.
Yeah.
And that could be as soon as June. I've heard some people say May, but I think the Treasury Secretary is sort of sticking June, July. I'll take, he knows more than I do, certainly on the topic. But that means Congress has to do something, and they have to do something fast, and they got to figure this out.
Yeah. Well, Steve White, it's interesting because when we saw that massive reversal on Tuesday, where the Dow went up 3,200 points because we're kicking the can down the road 90 days, or at least that was the narrative last week. Did we need, the biggest gain in one day for kicking the can down the road? That's why it's confusing to me.
Yeah, look, I think the reversal that we saw on Wednesday, I think it was had all the hallmarks of shorts getting their face ripped off right in front of us there, and the idea that you better be a little careful about positioning. It obviously got a little bit too negative. But to your point, Jill, and this is as we look on forward, even if we use the revenue from tariffs to fund tax cuts, maybe do some stuff on the corporate side on expensing versus depreciation to give companies some confidence to make some longer term investment plans. That's not really helping the bigger picture on the deficit. I think the Doge website now, Steve, this, it's like $150 billion or something is all they found. That's not even going to make a dent. So I think this highlights how difficult some of our issues are going to be going forward as we try to think about lowering what our annual budget deficit is, how we're dealing with our outstanding total debt. But I love this, Steve, the way you put this. It takes years to build confidence. You break trust really quickly. And if you're in a low trust environment, Jill, it makes that job even harder. I think this really puts a lot of pressure on us. We better be thinking about policies that help us grow going forward. That's going to be the best path for us. It's there. but it's not going to be easy. Some of these issues, as divisive as we are in Congress at the present time, man, I don't know if you could pass a bill saying the official color of the sky is blue right now.
Absolutely.
I was going to say something similar. I don't even think there's really been much that has been introduced, if at all. So Steve Sosnick, to wrap this up here, how much longer is corporate America and the market going to be able to manage these gyrations? It is going to come to a breaking point. The resolution needs to happen at some point. It's only going to be, absorbed so much.
It does, but the problem I think comes, some of it is self-referential. At some level, volatility begets volatility in the short term, and to Steve's point, that rally, we saw that huge downdraft, so you got a big rally in return. Bear market rallies are I like to say are short, sharp, and ferocious because you get people on the wrong side, and FOMO is always there. No one wants to miss a move like that. But I think it's going to require some sort of we can't keep kicking the can down the road because what happens when we say 85 of the 90-day period? Corporations came and we're going to get a lot of what they can.
Yeah. All right, Steve, I think we lost you there, but we'll leave it on a note in terms of looking for a resolution. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.